So the December FOMC meeting happened, which was quite washed out by market participants. The reason was this was the first FOMC meeting after the change in administration in the US. So market participants wanted to really assess that how the central bank is looking at its various economic projections, after the change in the government. And, as we can see, although it's not really a very material change, but nevertheless, if you look at the inflation growth dynamics, now the FOMC looks at growth slightly more constructively, and they also expect inflation to remain slightly on the higher side. So if we look at, for example, the growth estimates, the 2024 growth was revised from 2% to 2.5%, and 2025 was revised from 2% to 2.1%. On the longer run, of course, growth estimates remained unchanged. If you look at on the unemployment side, broadly, FOMC is just projecting unemployment number of 4.3% all across till 2027, so which is quite stable. And bond market took it quite negatively, that without a meaningful shift in unemployment, how will really labor cost come down, and how it will really lead inflation to come down. So the feedback loop that we have been talking about, that high services leading to higher wages and higher demand for labor, which is leading to lower unemployment rate. It was expected that probably at some point of time, it will decide to show in wage cost as well as unemployment, but that's still awaited for some time now. And that's the same thing is reflecting in your inflation estimates. So if you look at PCE inflation projection, that was revised from 2.3 to 2.4% for 2024, and the 2025 inflation estimate was revised from 2.1 to 2.5. The same trend can be observed in the core PCE inflation estimates as well. So what does it really mean for interest rate projections by the FOMC members? So as we can see in the September FOMC meeting, the interest rate, or the median interest rate, as at the end of 2025 was 3.375%, which was now revised to 3.875. And similarly for 2026, the 2.875% was revised to 3.375%. So what does it really mean? It means lower interest rate cuts, as can be seen by FOMC members as of now. So what it really means is that earlier the FOMC participants were looking at rate cuts of 100 basis in the next year, and after that another 50 basis. Probably now they are looking at a slightly higher for longer interest rates as things stand today. So if we can see, they're just now projecting 50 basis rate cut in 2025 and 2026, and just one more. So total, they are projecting about 125 basis, rate cut compared to 150 basis compared to earlier expectations. Again, even the Federal Reserve in the past has said that the dot plots are broadly estimates as on a certain date, and they should not really be read into it very seriously. But nevertheless, it does all the projections. If we take them into totality, it shows that the Federal Reserve is quite confident on growth, quite confident of lower unemployment, and hence it is uncomfortable with inflation, and that's what's really playing out on their interest rate outlook. So overall, the FOMC meeting was taken a bit negatively from a fixed income perspective by market participants. And as a result of that, as we can see, there was a substantial sell-off in yields for the month of December. So the US 10-year yield, which was trading around 4.2% at the end of November, moved about 40 basis to end December at 4.57%. We can see similar movement across most of the economies. Of course, Brazil, we saw the highest impact because of a slightly higher inflation as well as fiscal deficit that Brazilian economy is facing. But broadly, most of the economies, we saw a rise in bond yields. The only exception was China, which saw decline in bond yields, which was due to the monetary and the fiscal stimulus provided by the central bank and the government respectively. And the expectation is that Chinese economy may continue to be on a slowdown path, and that's what really led to the rally in Chinese bond yields. But excluding China, across global fixed income yields, rose in December 24 because market participants are now expecting a much shallower rate cut cycle compared to what they were expecting in November of 2024.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.